The following is a presentation of TFNN.
All right, welcome everybody today to the Options Hour. My name is Don Kaufman with ThinkorSwim from TD Ameritrade. So welcome. Again, welcome to the Options Hour here today. We're ready to roll, talk a little bit about options, ask any questions, any and all questions. We are open here, of course, at 877-927-6648. Ask us your option questions because, again, this is the Options Hour. Give us a call. All right, so we'll give you kind of a quick recap of the markets, and then we'll jump right into things. And again, if you guys have any questions really involving options, futures, stock-related, I'll try to answer them. So today I come to you guys live from Dallas-Fort Worth, of all things. I'm actually out here at one of the TD Ameritrade offices, and apologize, I'm having a little bit of technology trouble as we get rolling here today. But we'll get things up and running. Looks like my software is running. Looks like you guys can hear me, and I guess that's all that matters. So with that, let's kind of jump into it. Okay. Futures right now. Yes, futures up 3. NASDAQ futures down 50 cents in the day. We've actually had rather tight range. Of course, bonds really not a big mover here today, which is no big surprise here on the bond market today. Again, I just want to talk about right off the bat a little bit about yesterday and what really went on. Obviously, so S&P threatens to downgrade the debt of the United States. Market sells off hard and rallies towards the close. I don't know about you guys, but I was a little bit disappointed. The thing I was really disappointed with is if you take a look at the VIX. The VIX, S&P 500 Volatility Index, wow, down 85 cents today. The VIX is actually down at 16. So really what that tells me is the announcement just got shrugged off. I mean, the bottom line is, and I was just really thinking about this yesterday. I was home. I was trading throughout the day before I hopped on a flight to come out here to Dallas. And, I'm just looking at the volatility and just, really kind of disappointed. I expected the VIX to really pop on that. The highest I saw it yesterday was a little bit over 3. It actually rose a little bit over 3, so we got up to about the 19 handle there a little bit yesterday. But pull up a chart here real quick on the VIX. Nothing. The market, when I say shrugged it off, it was just like, yeah, S&P, go ahead, threaten. We're really not moving forward. And it was, I guess it was kind of disappointing from an options trader perspective. You like to see a little bit of volatility in play from time to time, and we just didn't really get that feel yesterday. The other thing that was really surprising yesterday is some of the kind of contrary indicators. So this downgrading of debt comes out, and of course interest rates immediately shoot up. And if you watch things like TBT actually took off to the upside yesterday, and it faded fast. So it was this big initial knee-jerk reaction. Interest rates go up, obviously, because the debt was being threatened to be possibly downgraded. And ultimately, that was the first notion that I saw that the markets were probably going to rally, was if you were watching some of the bonds and or some of the bond ETFs like TLT and TBT, these things flattened out. So TBT was up pretty good yesterday and actually pulled back, and it was just, a nominal move on the day. Obviously, you saw oil down big yesterday as well. But really, the bonds was kind of the telltale sign, and then the VIX actually faded, and then, of course, the S&P 500 futures followed by rallying back up into the close. So really, again, for those of you that do trade some decent amount of options, probably a little disappointed there. And when I say disappointed, listen, I'm a contrarian. I grew up around option traders, big-time contrarian trader. I like to see some big sell-offs once in a while. It's typically, I'm long volatility right now, and it is what it is. For those of you guys that are long the markets, I'm sorry. I like to be short, and I like to be long volatility. It's a more exciting way to live. Anyway, if you guys are long the markets, you short the markets, you got questions in regards to anything trade-related here, by all means, kind of give us a call. And, hey, we'll get we'll get those questions answered for you. In fact, in regards to that, you guys can call up, hey, you can have a question in terms of really anything trade-related, and that is, Sorry, I got things popping up on my screen over here. When I say anything trade-related, you're thinking about doing the trade on the spiders. You're thinking about doing a trade on Apple, whether it's bullish, whether it's bearish, whether it's neutral. If you want to just talk about it, before you've done it, when you're doing it, hey, give us a call. We'll try to work out some different option positions, whatever is right for you. So with that, it looks like we do have a first caller on here. All right. First caller is John from Philly. He's got about crude oil. You there, John?
Don, I am. How are you today?
Good. Sorry about that. My instant messenger's cutting out, so the guys are I'm a little behind in them telling me there's a caller over here. So sorry to keep you holding over there. But what do you got for us today?
Hey, Don, I wanted to ask you, in trading crude oil with options, in past years I've traded options on the NYMEX crude and the USO.
Yeah.
USO has got this perennial problem where it is you've got contango-related losses each and every month on rollover generally.
Sure.
And now you've got this new phenomenon the past couple of months where NYMEX crude is trading far away from Brent crude traded on London. So my question is, are there any instruments that you're aware of that you've personally traded where are options on Brent crude oil?
You know what? So we personally do not offer them specifically on ThinkorSwim because the product hasn't had the liquidity of the light sweet crude oil. But the exact same problems exist in any of the crude products. So the one that we offer on ThinkorSwim is /CL, which is light sweet crude. And that's ultimately what we offer. Now, it's not to say that, other firms, sure, they offer Brent. They all suffer the exact same issues on there. To be honest with you, so I'll tell you what I trade myself.
Yes.
And give you kind of an idea.
Yes, please.
I actually do trade the USO, and even with the problems with the USO, the biggest problem with the USO, forget about the contango, forget about the rollover, because most of that problem they fixed, meaning that the USO, and I just pulled it up, it used to be a real pain in the ass because everybody knew that they were going to roll the oil contracts, and when everybody knew it, it basically worked against the USO. Now, they have actually fixed some of that rolling. They don't sit there and say, I'm going to roll on the third Friday of the month, and literally they used to do that. I mean, it was ridiculous. They would tell everybody when they were going to roll, so if you knew how to trade, you would basically front-run them, in their trade, and that's what
exactly,
the contango loss was.
Yeah.
So they fixed that problem, but it's still not perfect. The biggest pain I find in the USO, without a doubt, is the fact that the shares themselves are a limited partnership. So you have to file a K-1 and with your taxes. And, oh, man, my accountant yells at me, every single year because I actually trade some of the shares of the USO, but I trade options in there as well. I'm comfortable, and I kind of understand the rolling process, and I understand that USO tracks more front-month oil than it does back-month oil,
yeah.
Which, I get those short-term volatility and price swings, and I like it, and I like that product. The other product I've actually had quite a bit of experience with is XLE, which is, it's a different animal altogether because XLE doesn't always track physical oil.
Sure.
But without a doubt, the XLE is the best product to trade energy sector-wise, and it's because of the tight markets on it. The liquidity is excellent. And I actually kind of go back and forth between USO and XLE. There's one thing that I do on USO that seems very effective, and that is I do own shares of the USO. So I do have to file the K-1,
right,
which is for a limited partnership.
Yep.
But I sell out-of-the-money calls against it. It's like selling a covered call.
Yep.
But what I'll do to offset the contango, which is basically, when I say a contango, for those of you guys that are listening, if USO right now is at 43.20 and they start rolling, the physical crude oil futures from 1 month to the next, what that does in effect can adjust USO down very slightly. So if you imagine one day USO closes at 43.20, the next day it opens at 43 even, you're like, where did the 20 cents go when oil doesn't even move? It's because of that roll, and they're charging you for that roll, and they're charging you for the leverage of that. Ultimately, what I'll do is I'll sell out-of-the-money calls. So, for instance, if I owned 1,000 shares of stock, I won't be short just 10 out-of-the-money calls. I might be short 15 or 20 out-of-the-money calls. Further out of the money, though.
Really good idea, Don. Yeah, I like that, yeah.
And it actually offsets. The only thing is it ties up a lot of margin if you don't have portfolio margin in your account.
Yep. Yep.
So it's extra back month call units against it. And I'll sell them so far out that if I can even collect an extra 30 cents, it offsets all the contango, and I still get, good, basically good overall movement on a day-to-day basis with oil.
Right. Hey, that's a helpful idea, Don. Thanks so much.
Yeah. All right. Thank you for giving us a call.
Okay.
So, John actually, obviously, he knows his oil trading there because he knows what a contango is, and you don't get that often. So we're going to jump right to another caller here, and that's Ken Sarasota. Ken, are you there?
Yes, I am. How are you?
All right. So sorry, I'm having a problem with my instant messenger today, and I can't really tell who's calling in. So it always makes it more interesting. I saw that the guys actually messaged me right here in the chat room there in the Tiger Den. So what do you got for us?
Well, the question I have is, last week I was looking at a trade to short one stock and to go long another stock against it, and I couldn't get the trade done because the short stock wasn't available. So I was thinking, is there a way I can, but the options on it were trading. So I was trying to think, is there a way I can put that trade on using options?
Absolutely. So, you know what's interesting about that? So you're trying to do what's called a pairs trade. When I kind of first got involved in this business, I used to do a lot of risk management stuff, and I used to do a lot of pairs trading. And pairs trading, by that, I mean like an age-old pairs trade is like long NASDAQ, short S&P. Okay, and that ultimately is, a type of a pairs trade. Now, you can do the exact same thing in options, no question about it. For instance, if you wanted to get long, you could sell a put spread, okay? Or you could buy like an in-the-money call spread to get long an individual stock. To get short the other stock, you could basically do the inverse. You could sell a call spread or buy an in-the-money put spread to get short the opposing underlying. Are you aware that there's a new product that just launched yesterday that does just this?
No.
Nobody knows about it yet. AVSPY. I'm going to pull one up here. Are you on? Are you actually on a?
I'm not at a machine right now.
No problem. I'll explain it to you. So there's a brand new product that just got launched, and there's a new option disclosure that had to come out in regards to it because nobody's ever launched a product like this. The product is launched by NASDAQ. It's called NASDAQ OMX Alpha. Okay, options, and what these alpha options are is it's one underlying versus another, and it's done on 16 different underlyings versus the S&P 500. The one I have on my screen, the symbol is A as in Apple, V as in Victor, S as in Sam, P as in Peter, and Y, so it's AVSPY, and what that does is it measures the performance of Apple versus the spiders. So if Apple outperforms the spiders, the index goes up. If Apple underperforms the spiders, the index goes down. And it has options listed on it. So there's no underlying stock to trade here. Man, it's simplified it, and it's going to save you a hell of a lot of commissions.
Yeah.
So,
can I go back to your earlier example, though, because I was thinking of some of the things. Like, I was figuring on the stock I wanted to short, okay, I can buy a put for that.
Yeah.
And then I was trying to think, now, what's the logical way to get long the other stock that I wanted to be long against it and try to keep the risk and everything else as close as possible? So buying a call, and forget whether it's a spread or not, doesn't really matter. Buying a call didn't really work, I thought, because now I'm paying two premiums where I'd rather be paying one and receiving another. So if I sold a put on the other, it wasn't clear to me that I had a similar risk position than I would have had going long and short in the cash market.
Right. I got to be honest. With what I would do if I were you is ultimately I wouldn't buy a put or a call on either one of them. I would probably sell a put spread on one and sell a call spread on the other. That way, basically, if nothing happens and the spread doesn't work, you're still profitable.
So sell a put spread and buy a call spread. Is that what you said?
You could sell a put spread, for instance, in the one underlying. That gets you bullish. You could sell a call spread in the underlying, and that would get you bearish in the other underlying. It's basically what I would call, there's no easy way to put this, like a bastardized iron condor. So an iron condor is a net neutral trade, and it profits from that neutrality. This does, efficiently almost the exact same thing.
Okay. Now, how would you get your ratio between the two? Like, say, for example, one stock, if the one I want to get short, let's say, is a $10 stock, and the one I want to get long is a $50 stock, would you use a 5-to-1 ratio on the number of contracts?
So you could use a 5-to-1 ratio. That's actually that's exactly what I was just about to get into. That's the ultimate question here: is how many do you get long versus how many do you get short? Right. And let me tell you, that's not an easy answer because you can't just do a 5-to-1 because what happens if the stock that is a $10 stock is trading at 5 times the volatility? So if the volatilities are relatively similar, meaning let's say that like Spiders, for instance, trading at a 16 vol, and your other stock is trading at a 16 vol, then it's easy. Then you can use a 5-to-1 ratio. But if the volatility of one of the underlyings is double the other underlying, you have to actually compensate for that.
And would that be like therefore 2.5 to 1? I mean, would you go?
Sure. Exactly, and you could figure it out exactly at 2.5 to 1. Now, there's one other way to do it, and it's called beta weighting. And are you familiar with beta weighting at all?
No, I'm not.
Beta weighting basically takes the stock's beta. So the beta is the relative movement versus the S&P 500 of any underlying. Okay, you can actually take the beta in ThinkorSwim on the Analyze tab, and you can say 1,000 shares of Spiders equals how many shares of Apple computers.
Okay, yeah.
And it weights it together so that you would know what your pair is equivalent to. Does that make sense?
Yeah, absolutely.
Yeah, and if you are on ThinkorSwim and you ever have a question about beta weighting, call the office, man. Those guys will walk you right through it. They're fantastic over there.
Okay, great.
Yeah, no, sorry. I like talking about this new Alpha product. Check it out.
That's interesting.
Because it's exactly what you're talking about, and it's like the same concept. In fact, I'm going to talk about it in the show here just as soon as we hang up.
Okay, great. Thanks a lot.
Yeah,
that's really helpful.
Thanks for giving us a call, Ken. All right. So, Ken was actually gave us a call and kind of led into exactly. So Ken was actually gave us a call and, again, led into exactly what I was planning on talking about here, and that is, there's a new product out called Alpha Options, and I'll discuss it here in just a moment. With that, doesn't look like we have any callers on the line right now, so you need to call us at 877-927-6648. And we have had 2 rather experienced traders already call in today. One of them talking about pairs trading, which is one underlying versus another underlying. Another caller actually already asking about, trading oil and the contango in the roll. Oil really is, I'll go back to the pairs trading in a second. Oil becomes kind of a difficult product to trade because it's a commodity product. And there's definitely different factions of trading a commodity product. It doesn't work like a straight equity. I mean, when the spiders go up or down, pretty much dollar for dollar, you're going to make or lose a dollar. It's very different, though, in oil. And, one of the products I like to explain this on is like the VIX. The VIX is, an index that is traded. It's basically it's the S&P 500 volatility index, and I'm just not an advocate of the VIX product really at all, and I'll kind of state why, because this kind of brings to the forefront of why some commodity products are very, misunderstood by clientele, and this is frequently, even professionals misunderstand somehow these products work. If you take a look at the VIX right now is trading at $16, and if you were to go out, for instance, and you were to buy these 16 calls, they're trading in May for $3.70. Okay. Now, if the VIX were to skyrocket, let's say the VIX goes from 16 and goes all the way up to 24, almost instantaneously. So we go from 16 to 24. Now, immediately, you think this option that you bought for $3.70, this option should go to what price? Well, it should go from 16 up to 24, which is what? It's $8. So the option should jump from $3.70 to $8 minimum, plus a little extra there if there were time value, right? But the ultimate truth is the VIX prices its options off the forward future, not off what the underlying VIX is doing, meaning that even though the VIX spiked to 24, the world is already pricing the VIX is going to revert back down to 20. Therefore, the option only goes from $3.70 to like $5. And you're like, you call a place like ThinkorSwim or TD Ameritrade and you go, oh, they screwed me. And we go, who screwed you? You go, the market makers. It's not fair. Well, that's, why you got to understand some of the products that you guys trade. And the VIX is a perfect example of that. It's a very convoluted product there. At times, oil can have a little bit of what's called a contango, in that its front month and back month options can trade literally off of different values of crude. And if you look on the ThinkorSwim platform, it says active only. You can pull up different months of crude, literally trade different prices out there. And you can see that the contango here is relatively minimal over here. And you also have areas of what they call contango and areas of what they call backwardation. Anyway, with that, I want to kind of jump forward to another caller. And before I take this next caller, you need to call us at 877-927-6648. All right. I need on the line Ken from Louisville, Colorado.
Yes,
all right. I got it right this time, man. You're from Colorado.
Yes, how are you doing?
Good. How's it going?
Good. I would like to hear about trading TBT and TLT in general, and then what you think might be appropriate for trading them right now.
So I guess the first question I got for you is you want to get long or short TLT?
I don't know if I want to get either.
All right. So I'll kind of explain some of the products. I trade TBT, and TBT is the double inverse of the TLT.
Right.
And the TBT, it's some of these double inverses are not great products. The TBT is a better one, but anytime you have a double inverse, okay, they're charging you for that product being double, meaning that, hey, the TLT is a $93 stock. The TBT is a $36 stock, but it trades as a double. So ultimately what that does is there's a cost of carry built into the TBT that is not transparent, in that they're really charging you as if this were double $36, which is basically $70.
I've noticed that just by comparing it to TLT.
Right. Right. So, and what happens is over time they adjust the TBT downward very slightly to cover the cost of carrying a double position. All right? And that's really, really kind of important on there. So with that, when I said, hey, what do you want to do with TLT or TBT? Myself is I'm net long TBT. It basically means I believe interest rates are going to go up. Right. I mean, that's basically the position I take. Now, I'm net long some of the stock, but when you're net long some of the stock, you have this adjustment period down. If you actually read some of the rules from from FINRA or the SEC, they recommend that if you ever trade a double inverse, okay, I love talking about the disclosures here, but they always recommend that you never hold any of these double or triple inverses more than 1 day, because they're only meant to track for 1 day. Now, myself, I hold shares of the TBT, but I'm comfortable holding them because I sell tons of out-of-the-money calls against them. And this is exactly the same thing I talked about on USO a little bit earlier. If I'm long 1,000 shares of TBT, I may be short 15, 20, even 30 contracts of calls against them. Now, the calls that I'm short, okay, if you were long 1,000 shares, a covered call would be short 10 calls. Well, I'm short, let's say 20 or 30 calls. Some of those calls are considered naked short, and that position ain't right for a lot of clients listening to this because it ties up a hell of a lot of margin.
Right.
So ultimately, if you wanted to get long TBT for the short term, you could either sell put spreads in it or buy like an in-the-money call spread. And I don't know if you're on the screen show right now or not.
I can't get that working on my computer. I can't get your current screen at the moment.
You got to call the guys from TFNN. They'll walk you through it.
Yeah.
Here, I'll give you kind of a quick example. Would be like,
there?
Yeah, what's that?
Well, I have been trading TLT with both iron condors and calendars, sometimes combining them both. Having some success. Sometimes they don't pay you enough to trade it.
You know what?
Volatility's been so low.
I mean, and volatility is low because they're bonds. These are basically ETFs off bonds, and vol on bonds is just horribly low. But I agree with the strategy right now because so the TBT had a massive move upward. It was at $29 for a low and shot all the way to 40. And again, I'm not looking at a chart, but I'll pop up a chart over here so you can see its low over here on the screen is 32. It even hit 29 and shot all the way to over $41. And it's kind of been meandering. I mean, it's definitely kind of a range-bound underlying right now. I'd expect it to maybe bounce up here a little bit. Interest rates have definitely been in play in the last 6 to 8 months. A lot of people believe interest rates are going up. But exactly what you're talking about, now that works. Iron condor is fine. If you just want to trade options, you might want to consider looking, at this TBT as well. And the reason is the TBT has double the vol of the TLT.
Right.
So for just a pure option strategy.
Dollar-wise, it seems to work out similarly.
It does, because it's basically it's the double of it.
And
right.
And the TLT moves more than you would think with the bond underlying. However, it's not available for short sales should you want to use that to balance your delta.
Yeah, no, it's hard to borrow. No question about it. And that's why if you wanted to balance your delta, you would have to come over here to the TBT and use the shares of the TBT. That's where things really start to get convoluted is when, you have a hard-to-borrow stock, but you can buy the TBT. It's like, hey, it's the exact same thing, except you don't want to hold necessarily the TBT for long periods of time.
So you're basically holding, you actually are holding underlying and selling even more than what you have in out-of-the-money calls.
That is correct.
And of course, when you say that, your mind's got to switch over to the fact that it's an inverse.
It does. It does. So my mind is really straightforward on TBT. TBT gets me long interest rates, and that's what I want to be. I want to be long interest rates.
Right.
You know,
so you're not
long interest rates, short bonds, and that's the easiest way I look at it. Is I'm like, all right, I want to be long interest rates. I'm going to be so I'll be long TBT.
Mm-hmm. And so
Yeah,
are you trying to maintain? What would your delta position be on TBT?
My delta position is still long. I'm definitely not trying to maintain like a delta neutral position on there. I'm comfortable being long the underlying, but what I do is, for instance, I've got like May options and June options open. I'll sell some of the 37s, some of the 38s, some of the 39s, some of the 41s. Then I'll go out to like June and I'll sell some of the 38s, the 39s, the 40s, the 41s, the 42s, and I'll just do like 5 contracts of each. And I'll literally be short like 30 contracts, 5 at a clip of 38, 39, 40 in both May and June, and it still leaves me net long delta. But because I'm short those calls, what it does is it offsets some of the decay rate associated with TBT, and it also cuts down some of my directional risk. So at any given time, if I'm long 2,000 shares of TBT, I'll probably be, my delta will net out to about 1,300 deltas.
Wow.
That's the neighborhood I try to keep it in.
What's a practical method of keeping track of a large inventory like that?
Go to the monitor tab. If you're on ThinkorSwim, literally go to your monitor tab,
right.
and just look at the aggregate delta on there. That's what I do.
But what if you want to get it to paper so that you can analyze it, outside of market hours, et cetera, see what you did?
Drop it in the Analyze tab. Even if it's a live position, whatever, you can simulate this entire position in the Analyze tab. So exactly what I just talked about in here, I'm going to the risk profile or add simulated trades. I'll go out and I'll buy, for instance, and I don't know if you're again, you're not really on the screen show here, but I'm buying 2,000 shares in the TBT here, and then I'm going to sell a bunch of different calls against it. I'll open up a few more calls in here and sell 5 of these. And I'm literally right now simulating buying 2,000 shares and selling 5 lots of out-of-the-money calls in both May and June, and it's giving me the live delta right now. And here I should be at 1,300 deltas, and I've got 20 contracts sold. This is really mimicking a position that I have on right now, and that is basically. Oops, sorry about that. I'm just clicking on my screen right now. Basically, I'm long 2,000 shares of TBT. I'm short 5 of the 38s, 5 of the 39s, both in May. Then I'm short in June the 38s, 39s, and 40s 5 times a piece. And that's ultimately my position. So I'm equivalent to being short basically 25 contracts against 2,000 shares to maintain. My delta right now is about 1,350.
Right. I've heard enough of your classes where I'm with you on not wanting to necessarily be delta neutral. I'm with you on the Analyze tab and the Monitor tab.
Yeah.
However, I would like to translate some of that to paper for my own record keeping and off-the-screen analysis. Any suggestions there?
Off-screen
you can really make a mess easily.
You mean like a physical piece of paper? You know what I would do? You put it in paper trading too. It might make it easier to put the entire position into paper trading. I'm always like paper. I don't actually write it down. Or what you can do is build it in the Analyze tab and kind of just take a screenshot or print it out, and that way you can kind of play around with it from there. But the reason I leave it in the technology, even as a simulated position, is once I have it in the technology, then I can go over, I don't know if you're familiar with set slices. You can go set slices $2 and $5 out of the money.
Oh, yeah.
And and it'll show you what your risk is if you move up $2, up $5, down $2, down $5. And that, to me, is the most important thing in the entire ThinkorSwim platform. I mean,
right.
Hands down, is to be able to ascertain what my risk is in the future.
Okay, and the last question I would have is, I understand you have the philosophy of not adjusting positions. Can you contrast that with somebody who has the other philosophy? Because I've heard both.
Sure. So I adjust positions. I don't adjust individual trades. So when I look at this trade, for instance, I'm long 2,000 shares of TBT, and I'm short all these 5 lots. There's not any one individual trade in here that I'm going to go and manipulate. If I want to tweak my position, I'm going to add more inventory or close inventory to mitigate the risk of this position. What a lot of people do is they're like, I have an iron condor on, or I got a vertical spread on, and they go in there and they try to fix that one vertical spread. The moment somebody says fix, okay, there's only a couple things that can happen when you're fixing a trade. Number one, you're spending more commissions. Number two, you're adding more risk to a trade that's already losing. I mean, literally, that's it. That's all that can possibly happen. So it's more commissions, and it's going to put more risk on the table. Like it or not, even whether you win or lose, it's still going to add more risk when you fix a position. So for me, it makes more sense to basically just open up a new trade that helps the overall position. So I'm much more of a position manager. I can't stand when somebody's like, oh, you can fix any trade, you can morph it into anything. You know what? Take a car, drive it off a cliff, and then bring it to a body shop and see what they say. Because it's
that's going to keep that losing, the trade that is either losing or viewed as a problem.
Well, the trade that's losing, I mean, an individual trade that's losing, it's defined risk, and hopefully you traded it small enough to the point where you can hang on to it, and maybe it turns around, maybe it doesn't. You know, that's kind of like you have a trade that has a 70% probability. So you got a trade that's got a 70% probability of making money, but that trade also has a 60% chance between now and expiration of looking like a loser. So knowing that, so think about that. I mean, that's purely the math. That's the way the math kind of works in options trading.
Right, that's important.
Right. So 60% of the time, your trade is going to look like it's, you know, an absolute train wreck. The question is, did you trade small enough in defined risk that you can hold that train wreck long enough for that 70% to turn around?
Yeah,
and that's
that happened
a big
after
deal.
Adjusting.
Yeah, by adjusting, right. And you know what?
No, I adjusted, and I should have sat it through.
I tell people this all the time. A couple of years back, and this Tom Sosnoff, you know, who I've worked with, literally been traveling around with the last 11 or 12 years, has never let me live this down. I took a calendar spread. The calendar spread had $1 and some odd risk on it. So let's say the calendar spread had $1 of risk on it. What's sad is I actually remember exactly what it had for risk. But let's say the calendar spread had $1 of risk. So I had a calendar spread had $1 of risk. The market moved away from my calendar spread. So what I did is I diagonalized the calendar spread. I embedded a vertical spread into the calendar spread. So I took a trade that had $1 of risk. I dropped one of the strikes down, the short strike down, and embedded a vertical spread that had an additional $2 of risk. And then, you know, the market like rallied back up through it, and I took a trade that I could lose $1 on, and I lost $3 on it. You know, and basically to this day, those guys are like, wow, you know, you almost had to try to screw up that bad. And when I thought about it thereafter, yeah, I should have just let the thing blow up in my face. You know, what's funny about it is if I had left the initial trade alone, it would have actually worked out. And just over the years, I'm much more of a position manager than I am an individual, like, trade placer, I guess, in that I don't go out and put one iron condor on. I put multiple irons on. I spread over many, many strikes over several expirations, and I call myself much more of a position manager, and I try to massage the overall position to a delta level that I'm really comfortable with. And it really keeps me away, of course, from butcher and things. Like if I had one giant iron condor on, amen, I totally hear you. You know, you got to do something if you had one giant iron condor on, but that's just not really my trading methodology.
Do you ever get long the market? Were you long in the much of 2010?
You know what? I'm actually I'm long in a 401k and I'm long a little bit in my IRA. So in my short-term account, I typically like to be short stuff. When I say short-term account, you know, and you know, I am actually long markets. And in February of 2009, I stood up in New York City, and I'll never forget this, the Marriott Marquis in New York City with Tom Sosnoff. 800 people packed in a room in February of 2009, and Tom and I were like, for the first time ever, get long everything, get long now, because the world is not coming to an end. And I thought people were going to start throwing stuff at us.
That's good. That's good to hear. It's good to hear you say that, really.
I was long until June of 2009, and then I got short, and I hemorrhaged a little bit there and just kept selling out of the money stuff and trying to keep my head above water. But, you know, being a contrarian is not always about getting short. Being contrarian is when it feels like the world is coming to an end, somebody's got to step up and buy. I mean,
that's why I asked.
Yeah, that's part of it. And I got to tell you, there's actually somebody in the chat room says, yes, I was there. Literally I thought people were going to start throwing at us then. But nobody wanted to get long then. And I'm going to tell you something really interesting about the markets right now. I did a presentation with Tom Sosnoff last week in Boston, and we stood up in front of like 400 people, and we were talking about something, an interesting phenomenon that's going on. So obviously TD Ameritrade, ThinkorSwim are one company now, and we watch very carefully client balances and margin balances. And one of the most interesting things to us in 2008, in October, November of 2008, margin balances, meaning the amount of capital that our clients were borrowing, was almost zero. Nobody wanted to borrow anything back then. They were like, the hell with this. I'm getting killed right now in the market. Right now, margin balances are 4 times what they were in 2008, which tells us one thing. Nobody in the world wanted to buy in 2008 and 2009. We all now know that that was the best time to possibly be a buyer, right?
Right. This is a scary contrary indicator.
All of a sudden, we have 4 times the amount of capital they're borrowing and stealing basically to get long right now, and now we're nervous.
That's why
Seriously.
The VIX is so low, lack of fear.
Yeah, and the VIX has always been kind of that contrary indicator. I don't trust the VIX as much as I used to. I just don't. It's because the VIX now is a traded underlying. Everybody's talking about it. I mean, geez, even Kramer's talking about the thing, right? And it's kind of something everybody's watching. So I keep a good eye on the bonds versus the VIX versus the futures out there right now. A little bit of each of them, to kind of get a little bit of better indication of what I think we're going to do. And again, I watch order flow. I'm not like big technician. I don't look at this and say, I think we're going up, I think we're going down. Based on what? Goldman Sachs earnings came out, this morning. Did you see that? Goldman's earnings this morning?
Yeah.
Goldman's earnings were absolutely spectacular, stellar. Stock's down $3. It's kind of one of those things like if you had the news the day before, you would have definitely got long Goldman, and you would have lost money today. It's buy the rumor, sell the news, apparently.
Yeah, good thing we don't know.
No, and that's, it's kind of the reality of the business. Right now, and I think I said this last week as well, but I've had great market feels over my career of trading, meaning like there's some times where I'm so hot, it's like, man, hey, the S&P will trade 1308 and then we'll revert back down $6 before rallying to the end of the day. There's times literally as a trader you're that hot. I'm so cold right now I couldn't find the front door in my own house. I really feel that way, and it's unfortunate because all of us do. And most of us are sitting with some type of short position. It doesn't matter. It's kind of like the markets are just meandering here, trying to get a footing under them. Volume is extremely low. That could also be a consequence of some of the new legislation that's out. When you look at the spiders, they traded 80 million shares today. Come on, we only have a couple more hours here left in the day, and we've only traded 80 million shares in the spiders. These things should be cranking at 200-300 million shares with a good day. So, yeah, I can say there's a lot going on in the market, but at the same time, there's absolutely nothing going on in terms of direction.
So how would you contrast selling call credit spreads on TLT versus bull put spreads on TBT?
It's, same animal, man. The exact same animal. I don't think it matters, one bit. Myself, I'm a little bit more comfortable trading TBT than I am TLT. And it's ultimately the volatility is a little bit higher in the TBT. I find that it's a little easier to kind of manipulate some of my trades. But if you take a look right now, I don't know if you're not looking at a screen show really, but
no, but I got it up here.
Oh, the premiums are just crushed down, man, in May in the TBT. So the premiums are not even worth selling. Like I look at the 36-34 short put spread. If I wanted to get long TBT, selling this vertical spread, the 36-34, a $2 wide spread is going for 58 cents. And it's like at the money. And if you look at the call spread, the call spread is the 39 call spread is even less than that. It's there's one thing that these options are indicating: we ain't moving very far. So ultimately, what they're actually indicating is it's kind of a dead market here for the next 31 days in that particular underlying. Even look out to
June.
I'm looking even at June, and things get a little bit more interesting in June. But I wouldn't sell premium any further out than that. The other thing you could look at that makes sense if you were kind of bullish right now in TBT is buying like an in-the-money spread. And I was looking at the 35-38 spread. so buying an in-the-money call spread for $1.37. The interesting thing is this call spread, it's the 35-38 May call spread. It's trading for $1.37. Right now it has $1.30 of intrinsic value, so you're only paying 7 cents for time value. It's basically, this spread is about risking, it's a $3 wide spread for $1, basically 40, so it's about risk $1.50 to make $1.50. Not half bad, you know? Not half bad at all on there. But that's, if I was going to put a position on TBT right now, it's purely options. That would probably be more along the lines of something like an idea I would look at rather than selling a put spread, because there's not enough juice in those puts right now.
How about calendars?
Yeah, calendars could definitely hit it right on too. And there's no problem with calendars. If you think we're going to stay relatively range bound or rally up a little bit, go for it. You know, I always forget to mention calendars on this show because clients are so pessimistic just about calendar spreads because they have trouble pricing them. The last couple of weeks I've talked a lot about calendar spreads in some of the ThinkorSwim chats that I've done, only because like like nobody seems to like calendar spreads, and I'm like, whatever happened? The calendar is not a dead strategy.
I like them better than I ever have now after hearing you talk about them.
Yeah, no, they make sense right now too. Vol is relatively low. Of all the products, I can tell you what, I have not placed a calendar spread in TBT. And it's a great product for calendar spreads. The only reason is my position already in TBT is quite large. Adding to it at this point is for me just pouring more fuel on the fire. And I've been long TBT for a very long time.
So if you're going to do a calendar spread, though, so you do a call calendar spread on TBT?
Yeah, you know how I was talking about call calendar spreads are not great on index products, but This isn't an index product. This is an inverse ETF. This doing a call calendar spread makes perfect sense on here.
And what about TLT? Do you consider that an index product?
I'm sorry, the which?
TLT.
Oh yeah. Well, it's definitely not. No, these bonds do not trade like a normal index would, like the spiders. The problem with the spiders is that if you look, the out-of-the-money puts trade for considerably more than the out-of-the-money calls. You don't see that effect happening on TBT or TLT.
So if you're range bound here, what would be the pro and con of a double calendar on what you see as a range-bound situation for the next 30, 60 days?
You know what? You could probably just get away with doing an at-the-money calendar and being range-bound with that. So it might save you a little bit in transaction costs just to hit the 37-call calendar for the next 30 days.
Well, you got me there.
Yeah, I mean, you might as well save some commissions because I've played that game doing a 34-39 calendar. Doing a 34-39, one on the put side, one on the call side is almost the same thing. Profit and loss graph is a 37-call calendar.
Yeah, and then, because if you're going to do a double calendar, aren't you always going to be losing out on one? You're hoping the other one bails out both of them?
Well, ultimately, you hope it falls right in between and both of them are a little bit profitable. But I'd rather, if it falls right in between, I'd rather buy the 37 calendar spread and hit it right on the nail on the head. And that's, the double calendar to me it's all right. It doesn't make a ton of sense, but, for strangling like a stock price, a double calendar fits into the same exact respect as almost like an iron condor. It's kind of a net neutral trade out there. It's really, in effect, how you're utilizing it. But I think in a lot of times it's easier just to go after the at-the-money calendar spread, and probably save yourself some transaction costs and a little bit of a headache, too.
Yeah, because I've seen it presented, as you said, kind of in partnership with the Iron Condor.
Yeah, it looks like we're rallying up right now, too. Wow, how exciting. I've never seen us rally before. The VIX is all the way down to 1573. Well, if the world is coming to an end, volatility isn't pricing it that way right now.
Right. How could the VIX be so low with such a small rally?
I don't know. It's just, they're just crushing this thing down. But I got to tell you, that S&P announcement yesterday caught everybody off guard. People panicked for about 30 seconds and then realized, it's just S&P. I'm sure that the government will control them as well. There was this sentiment that it didn't mean a damn thing yesterday, and that's ultimately what the volatility is saying right now. The one thing that was also interesting, I don't know if you track currencies, the euro versus the U.S. dollar. So today the euro is strong. It's up basically a penny versus the dollar. But everybody was saying
the dollar was up.
Yeah, it was up huge. So they're going to downgrade the debt. Let's rally the dollar. I'm like, I don't completely get that one. I haven't figured out exactly that move yet, but I was kind of laughing out loud because a lot of traders would have believed the opposite, that the dollar gets crushed, in effect, if the U.S. debt gets downgraded.
That's a lot of the promo out there.
Yeah.
Some of the underlying thought for that 4% of bulls or dollar bulls is that no matter what, however bad the dollar is, everything else is ultimately worse under hard-pressed conditions.
Oh, I agree.
I think rise.
I mean, on a personal level, like I really think that the U.S. has set themselves up over the last 20 to 30 years that our economy can't fail without everybody else's going down with us. So what does that do? It'll actually prop up the dollar. You know, the end of the world is coming, but don't worry, the dollar will probably rally. You know,
gold will probably go down.
Yeah. Well, the gold's the hardest trade out there right now. The supply and demand effect in gold, I think, is greatly manipulated by the fact that gold now became an ETF. And as soon as gold became an ETF, literally like GLD, they're having to buy physical raw gold to support the ETF. And it's again, it's kind of like the VIX. Well, as soon as they started trading the VIX became less effective. Well, now we're trading gold not only as a futures product, but now we're trading as an ETF. And I think that gold as a product becomes less effective to look at as an indicator. And the reason is it gets tied too tightly to a correlation with everything else in the market. I mean, trading gold directly versus dollars is a trade. Trading gold versus Dow, it's a trade. And those arbitrage relationships, I believe, really make stuff a little bit less effective, ultimately longer term for us. But gold will still be utilized as a gauge of fear, as will the VIX, and of course, as will bonds. I mean, that's kind of the nature of the business there.
Well, and you mentioned being long TBT and selling down the money calls. Does that mean you actually advocate holding the underlying like that?
I don't advocate holding TBT as it is a double inverse ETF.
No, I don't mean TBT. I just mean, in other words, you could be trading call spreads and do the same thing, or leap spreads and doing the same thing.
So myself, I like to trade against shares of stock. Like I like to trade options against shares of stock. So the reason I like to do that is I have portfolio margining, and it doesn't really matter. So my account can basically handle the margin. So I'll buy, a couple thousand shares of stock and sell a ton of calls against it. It's fantastic. I am so hooked on portfolio margining. It really
about 25,000.
You have to have 125,000 minimum to apply for portfolio margining.
Okay.
And seriously, you better have over 150 because if you go below that limit, they'll kind of smack you around a little bit for doing it.
Okay. And the point you're making is as to why you like holding the underlying instead of just writing against other options?
You know what? It's the only underlyings I ever hold, bottom line, is because I want to be long those underlyings. So there's no question about that. Like if I want to be long TBT, I want to be long interest rates right now. The USO, I want to be long a little bit of oil right now. However, that being said, I've actually wiggled out of 99% of that position right now in the USO. I was long oil until it shot into the over 110, and I've actually been unwinding it. In fact, I'm even short a little bit of oil right now. I'm short to flat right now. On my USO position. But other than that, those are the only two underlyings that I'm actually holding per se right now in a trading account. I own some other crap and some IRAs and 401ks, but yeah, those are my primary positions. I'm always looking to be able to buy something. I looked to buy Japan, but I missed that trade. I was kind of upset about that. Buying the Japan ETF out there, but so be it. And if you look at the Japan ETF right now, it's basically the options are showing that it's not going to move anywhere in a long time. Basically, they crushed all the volatility out of that thing. So so be it.
Do you think trading could be a way to generate cash flow?
Yeah, I did a lot of pairs trading in the past. I'm actually going to do a webcast tonight on the TD Ameritrade. You have to have access to TD Ameritrade for it, and it's about the alpha options, and we're going to be doing those on ThinkorSwim in the next couple of weeks as well. And it's about pairs trading, so I'm going to talk about it. I love somebody's mentioned about portfolio margining. Gives you a lot of leverage, but a lot of risk. No question, portfolio margining is definitely a double-edged sword. So I got to wrap up right now because I know we're coming close to the end of the options hour. But thanks for calling me back there, Ken. It's been good talking to you here for a while.
Thank you very much, Don.
Yeah. So again, somebody mentioned there G2. You mentioned portfolio gives you a lot of leverage, also a lot of risk. Anytime you got a lot of margin like that, in portfolio margining, the easiest way to say it gives you approximately 8 times the buying power, total double-edged sword. It gives you just enough buying power to blow yourself up. So if you enjoy chocolate-covered hand grenades, that might be the thing for you. I kind of crack up about that because it's the reality behind things like portfolio margining is it's very much a double-edged sword. But used correctly, if you know how to manage risk and so forth, it's one of the greatest things because portfolio margining was the last advantage I believe that the professional traders, really had over retail clients, is that they had a hell of a lot more leverage to buy stuff, and that gap has now been closed with things like portfolio margining. And not all brokers and stuff offer it, but we do happen to offer it at ThinkorSwim because we think it's just imperative. You got to learn to trade stocks, options, futures, everything seamlessly. Any of your currency products, it doesn't matter. It's all the same thing now. And as I say, all the time when I'm on with Tom O'Brien, I say, your risk is purely a function of your education in this business. And once you start to learn that an E-mini S&P 500 is the exact same thing as trading shares of the SPDR, and that is almost the exact same thing as the Dow, all these products really start to correlate. It doesn't matter. In the end, you can pretty much buy it or you can sell it. And somebody actually brought up in the chat room here that silver is at new highs. Yeah, I'm looking to that one to short. Me being a contrarian, I can't wait to short silver. So Tom Sosnoff and myself were both talking about that the other night in Boston as well. He's like, careful, nothing. Being a contrarian, it's all about standing up in the face of adversity. And if you ever want to get short silver, you could look towards some of the ETFs. There's, SLV, and there's the inverse ETF for silver out there. There's quite a few of them. But, be careful. Some of these inverse ETFs, once again, and primary ETFs can be a little funky how they trade. But, this, tell you what, you pull up a chart on SLV, that is a scary, scary chart to want to be a contrarian on. And if you look at the volume's peaking right now. It's absolutely exploding. Yeah, that makes me want to get short. I can't help it there. That's the nature of the beast out here. So for those of you that are long silver, good, go for it. That's why we have a two-sided market. You can get long, you can get short. It does not matter. If I do get short this, though, I'm definitely going to be selling out of the money premium. Let the market move up into me. So with that, I believe we have come to the end of our Options Hour. I will be back next week, but thank you, everybody, for joining us today. My name is Don Kaufman from ThinkorSwim from TD Ameritrade. Thanks, everybody, and I'll see you next week. Bye-bye.